Yes, question number 1. This is your case study number 3. See what I have done, in which sequence I have organized these case studies, no? Along with exam. I have organized in the standard series only, like 2, 3, because it's a mixed actually. 36, 105, 110, like that series only it will go till end. And last questions are complete balance sheets. Which one? No. Case based scenario, that yeah, it may come also, doesn't, like, we don't know, because in that also there, see, even though it comes, no, chances are very low shots this coming, because there you have this is one question there. But when they ask you case based scenario, on that case they will ask you MCQs plus descriptive questions, so that much is not there, no. Have they told only MCQs? Then okay, then it may come, this may come, anything may come. Okay, and I am telling you, see, initial days it is actually an opportunity, because as time goes, no, they start, like in audit only, I was just talking. In audit, if you see the original MCQs when it came, it was chiller, one line, this thing, persuasive evidence and all. Today's day you show me one persuasive evidence, one line, single line. They will ask you cases. No, again there is a strategy, okay. If you read the questions, a lot of things would have come from your RTP, MTPs and all. You have to practice that. Okay, don't worry. Let me see how things are going to come. I will do research now on the MCQ part. On 5th of April, fire damaged a consignment of inventory at one of Jupiter Limited's warehouse. This is when it happened, on 5th of, yeah, this inventory had been manufactured prior to 31st March 2012, costing 8 lakhs. The net realizable value of the inventory prior to the damage is 9.6. So this is your NRV. Cost was 8. Already 31st March it was there. On 5th April it got damaged. Because the damage caused the consignment of the inventory, the company required to spend additional amount of 2 lakhs on repairing and repackaging. Have we discussed something like this? Somewhere in days 2 also similar things had come. The inventory was sold on 15th May 2012 for 9 lakhs. The accountant, okay, now this is the story. Now what happens, see, again, whenever they say analyze, the word analyze includes understanding, looking into the components, because they could have mixed so many things, compare it with the provision and give your analysis, what it is. Like doctor will analyze the patient, he will say look into the eyes, look into the tongue, like you have to look into the individual components here. No, because it can be mixed with 2 is mixed with 10. All are L3 questions, nothing is on a standalone here. The accountant Jupiter treats this event as an adjusting event and adjusted this event, causing damage to the inventory in the financials. So what he did, 8 lakh was the cost, NRV 9.6 minus 2, he has done 7.6. And what is the value of the inventory? He said lower of this 7.6. Now analyze whether the above treatment by the accountant in this regard to the financial year 31st March 2012 is in compliance with Ind AS. If not, advice. See, always analyze will come with the advice here. The correct treatment along with the workings. Which one? What? Okay, first of all, what did he do? What should have been the NRV? 9.6 only. What he was supposed to deduct to? This is the additional cost, no, which they incurred in the next month. 8 is your cost of the stock. Okay, till 31st March, cost was 8, NRV was 9.6. At what value it was shown in the balance sheet? 8. Then on 5th the fire happened, no. So this was the additional cost to repair that envelope, water leakage and all was there. Similar question. Then he incurred that additional, he said that okay, is the cost to sell. So 9.6 minus 2, he did 7.6. So now NRV has become less than 8. he revalued this inventory and kept back to 7.6 and charged off this 0.4 to P&L account. Now, if when the financial statement went to the board of directors for signature, which value was there in the inventory? 7.6 was there. Now, the director got confused. He asked you, should it be 8 or 7.6? Because it is hitting 40 crores or whatever it is, no? Big amount of hit is coming to P&L account. Is that accountant's work correct? You just tell me, is it should be 8 or it should be 7.6? This is 1, this is 2. Which one is what is your opinion? First. Why? Why do you say non-adjusting? There was no uncertainty. Okay, because the event itself, like whatever that uncertainty came, see, till 31st March, there was no uncertainty related to your selling price. But that uncertainty came after the 31st March on 5th by happening fire. So this becomes a disclosure. There was a non-adjusting event, it becomes a disclosure. That's why, see, there is nothing much to work here. You have to theoretically explain what does Ind AS 2 says, what does Ind AS 10 says. To tell that, you need to understand that there are two elements sitting here. One, inventory valuation, another is your Ind AS subsequent events. Clear, no? So first, yeah. Yeah, because of the fire, there was an uncertainty related to the selling price. There was nothing, no fire also, nothing more. There was no. So that means you are sure that 9.6 you will get. If the fire would not have happened, how much you would have got? 9.6. There was no uncertainty, no? The fire caused that uncertainty. Clear? So, how do you write this? See, you have to practice it. First you say, as per Ind AS 10, what is a subsequent event? It is the event which occur between the end of the reporting period and the date when the financial statements are approved. Like from 31st March to board of directors approval date. This is your subsequent event. Now there are two types of events called adjusting events and non-adjusting events. If that event gives you the evidence about on the balance sheet date, it is an adjusting. If it doesn't, it is an indicative of the condition, it is non-adjusting. So when you talk about a condition, for simplicity's sake, Ind AS didn't say, I am telling you, simply consider condition is equal to uncertainty, which provides the evidence about the uncertainty that existed, or which indicates the uncertainty. Because if you look into this particular case, there was fire happened, but that fire, did it cause any uncertainty to the balance sheet value? No, because it already 31st March fire would have happened. On that day only, on 4th of October, you don't, or 4th of April, you don't know what is the value. Now assessment has to happen, fire has to be lit, then you will come to know what, that is an uncertainty. Followed, no? So entity shall not adjust, you have to only disclose for the non-adjusting event. So this way you write the theory for any analyze and advise. See, for you an identification is analyze and advise. So what is your Ind AS 2 says? It should be measured at a lower or cost value. And what is your NRV? Because there is a, whether should that be 2 be deducted from the NRV? For calculation purpose, should I deduct 2? Who told me? That is what you call Ind AS 2 and say that NRV is the estimated selling price less estimated cost of completion. You say that whatever was deducted no 2, that was an estimated cost of completion. Okay, now you start your applications. You say that in the given case, it is a non-adjusting event because there was no condition. So the accounting treatment given was not correct. What should have been the correct treatment? That is what they say, advice. Your analysis is done. You have to value inventory at 8 lakh rupees. And since it is a non-adjusting event, they need to give the disclosure if it is material. Are you clear? Easy, no? Okay, so practice this. And this is again whatever their language, I have given in an exam language only. You write this easy. Yes, this is case study number 4, which is on Ind AS 36 impairment. Now, on 1st of April 2011, Sun Limited has acquired 100% shares in Earth Limited for 30 lakhs. Now, Sun Limited has got 3 CGU ABC with a fair value 12, 8 and 4 lakhs. The company recognized goodwill of 6 lakh related to CGU only. Now, where is this 6 lakh came? Yeah, CGUC only, but where this 6 lakhs came from? Maybe in this acquisition there was, sorry? Sun Limited has, no, wait. Please understand. Who acquired whom? Sun acquired Earth. The Sun Limited has got 3 CGU. 12, 8, 4. The company recognizes the goodwill for CGUC only. Or is it Earth Limited had a 3 CGU? You see, no. Does it make sense to you? Sun acquired Earth. And Sun has got 3 CGU, it seems. Earth should have 3 CGU, no? Now, okay, we can interpret like this. Earth had 3 CGU and now after acquisition it has become Sun CGU. Out of that you will give goodwill of 6 lakhs to CGUC. During the year 2012-13, next year, CFO of the company has a view that there is no requirement of any impairment testing for CGU since the recoverable amount is comparably higher than the carrying amount and believes that no indicator of the impairment also. Analyze whether the view adopted by the CFO of Sun Limited is in compliance with Ind AS. If not, what is the correct treatment? Now, I want to know your opinion. What is your analysis? Is this opinion correct? That's what he is telling. Okay. No, he is telling not required only. It should be tested every year. I don't know. That's what they are asking your advice, no? What you are going to suggest? There is one element of goodwill also sitting there. So what is your CFO telling, correct or not correct? How do you know? They said, where? No, yeah, it is 4 plus 6. What is your carrying amount? 10. 10, no. Have they told you recoverable amount here? No. See, it goes with like this. What is the equation for impairment? See, first of all, you need to understand here, Sun is a print mistake. This can be misinterpreted. I don't know. You are interpreting it correctly. Very good. Sun CGU. Okay. Now, impairment is equal to book value minus the recoverable amount. Now, what is the book value of this? CGUC? 6 plus 4. What is the recoverable amount? Not given. Which they said it is more than recoverable amount is more than 10. No. They said very clearly, very categorically that recoverable amount, whatever you get, that value in use or whatever it is, that is more than your book value. You know what is the answer here? He is right for A and B. Why? Because goodwill is not allocated, so you need not test unless there are indicators. But for C, he is not correct because impairment testing has to happen annually for. So this is your advice. Okay, but how do you analyze it? You start with the Ind AS 36 provisions, telling as per Ind AS 36, You shall assess at the end of every reporting period if there is any indication first. With the CFO said not there, leave it, not required. However, irrespective of whether there is indicator or not, wherever goodwill allocation happen, it should be tested annually. This is what your Ind AS 36 says. Then you go to the, in the given case, Sun has not tested any CGU on account of not having impairment, but the goodwill is given to C. So, what CFO said was correct for A and B, but not for C. So, what they need to do now, according impairment testing has to happen, they have to test the CGUC, okay, because this is the goodwill acquired on a and allocated to C. Clear, no? Easy, right? Okay. New generation question, next level. Mumbai Challengers, a listed entity, okay, it's a listed company like China, what is that called? Chennai Warriors, Mumbai Kings, like that, no? Cricket. It is a sports organization owning several cricket and hockey teams. The issue pertaining to the reporting period 31st March 2012. Very beautiful question. I loved this question, but never came in the exam. Owing to the proposed schedule of Indian Hockey League as well as Cricket Premier Tournament, Mumbai Challenger needs a new stadium to host the sporting events. They need a stadiums, no? Because they are the team owners. Maybe they organize games, they will try to get the advertisement revenue, everywhere business only. Now they need a stadium. The stadium will be forming part of the PPE of the company. Yeah, because through stadium they will earn the revenue. They will make the players to play there and give the rights to broadcasting to the companies. Companies will, what they will do, they will show the cricket match to you, and in between one advertisement slot comes and they will sell that advertisement slots to them. Okay, then advertisement companies will bring their picture there, and ultimately who will sell to whom? That advertisement company will sell to the person who is sitting and watching the TV. So this way it operates. The Mumbai Challengers began construction of the stadium on 1st of December, which is a PPE. The construction completed on 12/13. You are into 31st March 2012. But this stadium construction started on 1st December. That means on 31st March 2012, this was CWIP. It was CWIP. No? And in the next year it is completed. We are not interested. Now we are on 31st March 2012. Now the costs directly attributable to the construction are 140 in the month of December, and thereafter 350 have been incurred per month until the end of the financial year. The company has not taken any specific borrowing, although it has incurred finance cost, regular overdraft, etc., which were avoidable had the stadium not been constructed. That means this finance cost is directly attributable. I didn't take any specific borrowing, but I used my OD there. I would not have used OD if I would not have constructed. That means yes, general borrowing cost I can capitalize. But general borrowing means I need a capitalization rate, which we used to calculate, no? Capitalization rate, Ind AS 23. The Mumbai Challengers calculated the weighted average cost of borrowing of everything given, spoon fed, from 1st December to 31st March. That 4 month is 15% per annum on annualized basis. Have we learnt that? First question, on annual basis we calculated. In one of the study material question, only for 4 months they calculated. 3% per 3 month, 12% per annum. Now this is 15% per annum calculated for that 4 month period. The company seeks your advice of the treatment of the borrowing cost in the financial statement for the year ended 31st March 2012. What should I do? They are asking what should we do with the borrowing cost. Capitalize. So your advice is to capitalize. But how do you tell? For this, see, analyze is missing here. they may ask you. So you have to tell first in Ind AS 23 the provisions for borrowing cost. Then since they said advice, even though they don't tell, should you not tell how much amount you need to capitalize? Can you please pause the video and students work out the amount needs to be capitalized as a borrowing cost? Borrowing cost only, interest portion. They didn't ask you the total CWIP cost. Huh? Yeah, please take out your rough book. Please work out. Don't use the calculator. Yes, students. So please pause the video and tell me the number. Yes, students. So first number I got called 33.25. Yes. Any other numbers? You have to call back your understanding of 33, Ind AS 23. You are there now. You missed that, huh? But great. Huh? Sorry? 77? No, no problem. We'll come up with the different numbers. Let us see. Yes, Vidya. 31.5. Yeah, one more number. If any, or anybody agreeing to this, any of the numbers. Yes, Dhanashree. 33.25. Okay. 33.87. Okay. Anyhow, whatever mistakes, your mistakes, if you do, you understand, no? Please see this now. Okay, can we capitalize? Huh? 34.14 point, okay, no, I think 33.25 is correct. Okay, let us see. See, first of all, when you capitalize, you will capitalize. See, we had come across two things, no? Specific borrowing, general borrowing. When you talk about specific borrowing, capitalization happens based on the borrowing amount, how much you borrowed, irrespective of whether you have spent or you have not spent, secondary. Followed, no? And here it is a general borrowing because that OD could have been used for other purpose also. But when you talk about the general borrowing, you will always apply capitalization rate on the bills paid. They said very specifically here the amount of the bills paid. No, just take the bills paid and apply your borrowing percentage there and see how many months it is outstanding. But how do you answer it? See, borrowing cost goes like this as per Ind AS 23. First, you can tell that entity can capitalize the borrowing cost attributable to the acquisition, construction, production of a qualifying asset. Is this qualifying asset? Yes. Why? It will take necessarily take substantial period of time. So your analysis starts from there. Otherwise, every story is written there, and if it happens to be a subsidiary there, then no. So first you need to tell, is that asset? That's called analysis. Like one by one components you check and see, okay, is it applicable? Is this okay? You say that yes, first your step is clear. It's second thing you see, is this cost directly attributable? Any borrowing cost simply you cannot capitalize, no. They say, when do you say cost is directly attributable? One, you have taken specific borrowing, one well and good. No headache, because you know that this borrowing meant for this. But there can be general borrowing. Now, why did you take more OD? Could you have avoided it? Yes, if I would not have paid the bill, I could have avoided. So that is directly attributable. And if the incurred expenditure is incurred from the pool of general borrowing, because they spoke about the general borrowing, then you should speak on general borrowing also. Then how do you capitalize? You have to use the capitalization rate. Now, what is the capitalization rate? That is analysis, no? One by one components, you start explaining. That is called analysis. Like doctor will, I told you, do you have sugar? Yes. Do you take these tablets? Now, connected to sugar, he will ask some question. Then do you have this type of symptoms? Do you have got a stomach? See, all are interconnected. Then you get one comprehensive understanding of the problem. Then you give advice. Otherwise, without asking these questions, without doing these analysis, if doctor gives any advice, that advice is going to become ill advice. Impact is, we will see now, adverse impact on the patient, what is going to happen. Like this, if you have not analyzed all the components and any advice if you give, that becomes one wrong accounting subject matter of auditor's qualification. Followed, no? So you explain what is weighted average, because weighted average we have to calculate. So thus the final calculation. So how much you say? 33.25, no? So in the given case it is 15%. So you have spent 140, 15% on 4 months you will calculate, because, and up to when you will capitalize? No, sorry, until it becomes ready. But 31st March came now. Your capitalization, see, if they twist the question and say in January only this building was, stadium was complete, no chance. They will not do that. Then your capitalization will end only on the 31st January. Followed, no? Only 2 months you will calculate. So then you spend again 350 on this, you will calculate for 3 months, 350, 350. If at all this question they will twist and ask what is the cost of the CWIP, book value of the CWIP, then all these cost plus 33.25. Yes, what went wrong? If they ask you what is the book value of the CWIP at the end of the year, you remember in India 16 we had, no, somewhere we have to mention that. So be prepared, capital work in progress. Amount is the cost what you have actually spent plus 33 borrowing cost. So that's why, see student, one thing is we have already seen these questions can come as it is. But what if they bring certain twists? That's why please spend time on the question, which generally we don't do. We just go into the solution. But I always believe you have to understand the question very well. In a very integrated manner, you have to understand, like connecting what it is, what they are trying to ask. Is there any assumption sitting? And you see, you develop that as a practice. You will take it to other subjects, I am telling you. All subjects you will take that. Just in one subject you make this practice. Then automatically you start observing the tricks in what they do in other subjects. Huh? You don't need it. You don't need to hear me again. Yes, tell me what went wrong here. What all the mistakes happened? No, I would like to learn mistakes. See, what type of simple? Huh? Into 1 by 12. Okay. Now, does it okay? Is it okay? No, because is your construction complete in 1 month? No, then there you don't have any. Now you do up to end of the year. And why do you do 4 months? Because your closing came, 31st March came. Others would have continued now if reporting was not there. Yes, any other mistakes? Okay, you left that 1st December, you didn't see it. You took read it as a 31st December. Be careful, because our one misinterpretation, Baba, it's our body, our eyes, our brain. See, they should work in an integrated manner to help us, correct, no? So be careful, okay? We ourselves get fooled. Anyhow, no problem. Be more careful, that's what I can say. Clear, no? Nice question. Now, alternatively, they have told you one, you need not present that way. You can say total cost is this, multiply this, and you get this. So in exam, you can present it like this also. Okay, now that question I have split into 3 questions. So we will move to question number 3B. The first part of the question is clear, correct? Now Mumbai Challengers acquired and sell players registration on a regular basis. What is this? Players registration. See, first thing is, students, we don't have any idea. At least I don't watch any cricket TV. Cricket, I don't know what is happening. Mumbai Challenger is who, what exactly happening. But some people understand the process. Now, somewhere you should at least know, like clinical trial, I told you, no. We might not have done the audit. Just in Google you type, know the terminologies used. The player registration means they buy the players. You remember, you see in the headline, this guy got so much 5 crore bidding and all those things. Means that much money is paid to them. They have to enter into contract with me. Next 2 years or 3 years, you are going to play with me. So and you cannot play during this time in IPL match with any other team. For a player to play for his team, its team, Mumbai Challengers must purchase the registration for that player. Simply he will not play. No, why he should come and play with you in your team? And your team means so much money comes. You pay them fixed, variable for you only, advertisement for you only, so many things are for you. You are the one who is taking risk here. He is like an employee for you. These player registrations are contractual obligations between the player and the company. The cost of acquiring the registration, including transfer fees, legal fees, player agent fees, are incurred by the club. At the end of the season, which happens to be a reporting period, that it coincided 31st March 2012, Mumbai Challengers, the club reviews its contract with the players and makes decision whether to sell or transfer any player registration. The company actively markets this registration by circulating with other clubs a list of players and their estimated selling price. Because I have paid 5 crores to someone, but I don't want him in my team. So if somebody wants, I can give him 3 crore rupees. You go and with that team, chalo, you don't play me. Player registration are also sold during the season also, often with the performance conditions attached. Now in some cases, it becomes very clear that the player will not play for the club again because he has sustained one injury. His leg got fractured. So gone, he cannot play now. Being permanently removed from the playing squad for booking or whatever, that person might have removed. The playing registration of certain players were sold after the year end because you are involved in the process of selling, no? And some people have been sold after the 31st March. The total proceeds of the net associated cost are 175 crores, and this registration had got a net book value of 49. So your cost or whatever book value was 49 and you have got sold 175, but the sale happened after your year end. Now Mumbai Challenger is seeking your advice in treatment of the acquisition, extension, review and sale of registration in the circumstances. Yes, what did you understand? First of all, which all standards are applicable? Have you identified it? Okay, that's what they are asking. They want to see, can you treat this player acquisition as an asset? Which asset? Intangible assets. So Ind AS 38 is applicable. But can you treat them as your assets? Employees, can you treat as an asset? This is the key word. You got a contractual obligations there. You can contractually tie them next 4 years. These people, employees, you cannot tie. So if you treat them as a intangible assets and you are paid, can you capitalize these fees? Yes, that's your answer. What is that called? That IPR, that 115 is applicable intellectual property. It is over a period of time or at a point in time. And if it is a royalty based intellectual property right, when the revenue should be recognized? When, if it is a royalty based intellectual property rights, when the revenue should be recognized? If there is a intellectual property right, IP, there are two scenarios. One, I get a fixed consideration. Another, I will get a variable consideration, which is sale based, royalty, whatever it is. Now my question is, when should I recognize revenue? When I can recognize revenue? Okay, I have got one tender coconut. I want to sell this tender coconut. When I can recognize the revenue? When I get the money? What do you call in India's 115 language? Performance obligation. When the performance obligation is fulfilled. Which one? First one. PO is fulfilled. What about the second one? PO is fulfilled or IPR is delivered, whichever is later. You remember that license A and license B problem? I told you the favorite problem of mine in entire this thing. That is a fantastic question. So that is a different concept that you don't connect with here. Followed, no? That's a different, that they didn't ask you. It is for the player. For a player, it is an IPR. For him, it can be, but can he recognize? No. Why? It's an internally generated. Now you can recognize because you are paying their fees there. For him also, see, for him also is an intellectual property. That they didn't ask. No, here they are asking only for limited. For player in days where it is applicable. Understood? Nice question. Okay, first part is I'm happy. What about this extension? Which standard is applicable? They are doing some extension, no? Review. What review they are talking? Which review they are talking here? Which extension they are talking? No, did you see here that they have threatened with the injury? When the injury happens, what you are supposed to do? Impair. So what review they are talking is the Ind AS 36 impairment review, because there are indicators. No, somebody got impaired. Impairment of the player. He was already you paid some 50 crore rupees and kept in your balance sheet, intangible asset. But that player will not be able to play. So your book value is more than your recoverable amount. No. Extension means you are 105 held for sale. You are holding it for sale, no? That is Ind AS 110, Ind AS 10 subsequent event. You have sold after the balance sheet. 105 means you are holding non-current assets held for sale. So you don't want him to play anymore. Ultimately, when you buy a player, what is your intention? To sell to others, or you want him to play with you? Others is like a PP. The day you decide I don't want, that's why club review the contracts. Means you don't want don't want them to play with you. You want to get rid of them. How? By selling it. Beautiful. That's why you now review and classify from intangible assets into non-current assets held for sale. And then you will recognize them cost or your fair value less cost to sell, whichever is low. Nice question, no? Now after year end, what you sold, can you recognize this revenue? Is it a subsequent event? Adjusting event? No, because on the day there was no condition. No. Again, did you get a full sure shot, like what is it called, purchase order and all? Did you complete the sale? Did you fulfill your performance? Did you get transferred? No. So it's a disclosure. So how do you answer this? Okay, so these are all the questions which is sitting here. Maybe that's what I told, they didn't ask you till now, but any one of the questions they may ask you. They may ask you in MCQs these questions. Now first is acquisition. You need to speak about Ind AS 38 is identified cost. This theory you will write. Is it identifiable? Why? When you call it something as an identifiable? When you call some economic benefits, this is what you control for future economic benefit. That is for an asset. When it is legal or contractual bar separable. Now what it is? Legal. That's why it is identified. And will you get, are you controlling? Yes. Are you going to get future economic benefits? Cost can be measured? Yes. So cost associated with this can be capitalized because you have paid fair price. So the directly attributable cost includes your registration fees and all. Without that, you will not be able to use him. So amount capitalized will be fully amortized when? Over the period of the contract. Life of the contract. Yes, with this first part of the question you have answered. Now comes the extension or sale. Yes, player registration can be classified as an asset held for sale under 105. When you are going to recover it primarily from sale, and sale is highly probable. Is the sale highly probable? On what basis you say? You say that if it is committed to sell, actively marketed, that's what they told in the question. They have been actively marketing with other clubs and all. Unlikely that they will be withdrawing from that plan. So in the given, are you clear? There are 5 conditions. Any 4 or 5 conditions you can arrive. And then in the given case, yes, there would appear the management committed to the plan with the immediate sale and an active plan. Yes, by already they have marketed to the other clubs. Correct? This is from the question only we are writing. So can I classify them as held for sale? Yes, we can classify them as held for sale. So once these conditions are fulfilled, their value will be shown at the lower of carrying amount or fair value less cost to sell. And any P&L will be computed by deducting the registration from the sale consideration. Your cost will be deducted. And conclusion, it would be prudent if those classified for held for sale where unconditional offers would have been received by the end of the period. Anyhow, you have got 1 year time now to dispose it off. If you don't do it, get it back and recharge the amortization now. What you stopped at one point of time. Because the moment you move it to 105, no more amortization. Perfect. Now, since the player registration is disposed of a subsequent, yes, it is a non-adjusting because you cannot consider this as a sale. It only happens subsequently, no, when the performance is fulfilled, next month, next year. So you cannot recognize, it is only you can disclose. Now coming to the impairment review, can you recognize impairment? For this, it starts with the internal or external indicators. Because it is not a goodwill, it is not an intangible asset with the indefinite life. Or is it, what is the third item for which impairment annual? That is goodwill, development assets, indefinite life, and CW under construction. Now none of this it is falling. So you have to wait for the impairment indicator. You need not test every year. Now somebody is not playing, you need not test impairment. But he is not playing because of some injury, then you have to test for impairment. So asset is sold at the, when the carrying amount exceeds the recoverable amount. So important points I have marked here. This is what you need to write in your exam answers, because answer is very lengthy here. If you see, no, so much theory, if you write 10-15 minutes, we will go into this only. Then in the given scenario, it is not easy to determine the value in use of a player, correct, no? Can you decide the value in use of a player? Why? Why, you tell me? See, if you have to impair a player, it goes like this. See the concept here. To impair a player, you need a book value. Is it available? Yes. You need a recoverable amount. What is recoverable amount? Value in use, fair value less cost to sell. Do you have fair value less cost to sell? Yes, because other people will bid, no. Okay, give me that player, I will pay. What is the value in use of this player? You can't know. How can you value? How much he is bringing cash? How you will bring? So what you should do, if you decide, if you cannot find out the value in use, you add him to the nearest smallest CGU. Who is your smallest CGU? Those 11 players. Now who brings cash to you? Those 11 players, when they play as a team together, they will get the cash to you. Yeah, value in use at a 0. Then there was one question, I told you the management intention we need to look. If the management has got an intention to sell, yes, then you have to take it fair value only. If they don't have any intention to sell, that means you will continue, even the value in use is 0, you will continue with that. Yeah, please come back to me, whatever you please go through. Okay, I can tell you like this, value in use is 0, okay. At that time we were talking about individual assets. Did we speak about the CGU? No, if the value in use is 0, we can associate this to one CGU, no. That way we can try to impair. Okay, on a standalone basis, if you want to see, then management intention comes into picture. Do you want to replace this or you don't want to replace it? I told you the example of that fan. One of the fan is damaged. Now my intention is to continue because other three are running, no. And I can, as a group, they can earn. So in that case, even though value in use is 0, I will take their fair value. Yeah, anyhow, definitely you will definitely get this doubt. Okay, please come back to me whenever you come across any doubt. Now tell me, students, see, your value in use cannot be decided in isolation, okay, and cannot generate on its cash as a whole. So now there is, if you have to really impact, you can do one more methodology. We could have done that because we could have understood how much cash he is going to earn. Now again, one more thing you can see, how much insurance he is going to get. That also you can try, no? You might have taken one insurance policy on them. Are Baba, they simply will not leave, no? That's a cash inflow, no? Because you may get a compensation, no? When that person gets injured, you will get a compensation. That's a cash receivable. Fair value, see, if he has really got injured, now who is going to buy him? First of all, you tell me, who, if when somebody is getting injured, who on earth is going to buy that person? Now that means sale transaction can never happen. That does not mean you don't have a cash for impairment test, and it does not mean that entire cost can be written off. What you need to see is, okay, is there any alternative cash coming to me? Can I use him for advertisements as per the contract? So you may have to test that, you have to look, or check whether can you include him in a group, because that player is there means there is one Josh for all other players. He is there just to give Josh to the other players. And as a CGU, he may not be into, as a group you will get the cash. Again, judgmental. Huh? So many things are there. That's the only cash flow, because if you insure, you cannot sell. That's what they say, that in isolation you may not be able to see, but you may have to take a judgment there. Okay. So this is one of again value in use substitute, because your fair value would be scrap, no? When you get an insurance, what is the scrap, what is the fair value? Okay, see, again you can consider as a such type of situation we are not come across, because there is nothing to compare, no, actually. There is only one thing, is you have received a cash from insurance plus some scrap you received. This is the total cash you received, and there is no more asset to be recognized, no? Will you keep that asset? No. Then your accounting entry is, where is the question of impairment? If when the insurance comes into picture, they will give you only when it is damaged, when you cannot use it anymore. Then bank account or insurance receivable account debit to asset account. No, alternatively, if it's partly damaged, then I may still use it, like I may consider this is the total receivable amount plus a damaged asset, how much it can earn me. That is okay. Insurance receipt, if you ask me, it is value in use. Value in use. You can treat it like, because value in use plus damaged asset also will earn you on something. This you compare with, take lump sum and take this damaged asset. Yeah, 1 minute. Don't worry, students. It has, till now it has not come. You have not seen the real face of question. Next question you see now. The famous landmark case for me is the Neelanchal and Uttaranchal Limited, which is next, that part C. If you see that, then you tell me what you are going to tell. But these questions are there to make you afraid, to be on high alert mode. Show me single examination till now in the past 11 where this type of questions have come. They may add, but not that extent. See, you have to please trust ICA. You are simply generalizing. What I can find, no, you are generalizing in the sense, one question you see and say, sir, in all MCQ this type of questions are going to come, all descriptive also this type of question is going to come, in interview also they are going to ask me this type of question only. This is what I see. Please, that worst case scenario probability is only 5%. Followed, no? And please trust. You should have seen. And see what they test, no. They know how you make mistake. That's it. And despite, again, one more thing I want to tell you. See, lot of people don't know lot many tricks of ICA. No, they clear. No. See, I'm telling you, lot of people don't know lot many things what they do. They clear. No, and I'll tell you. See, now you are in a much advantageous position that you have to keep in mind. Because at least, see, by looking at it, you make grasp know what they are doing, which sometime back you are not aware only, no? Did you knew all these things? That's what, no. So, I'm telling you, please be comfortable, okay? What you see is one question on an isolated basis. You take any past examination questions, except this November 23. No, except November 23, any past examination FR you take, you just see, no, you should feel comfortable there. But the problem is, if you are not thorough with the question, they have put so many traps here and there, that here or there you would have got caught. Now, if you are alert, if you are conceptually clear, then clearing any paper is not a difficult thing. You take audit also, same story. You take direct tax, you name it. Everywhere same story is same. Chalo, that day worst situation, worst paper came. Definitely tell me this time in general FR marks are very good. Audit marks I don't know where it has gone last November attempt. But people were shocked for the FR. Nobody told anything about audit. But if you know, if you see the general marks, no, audit has gone for a toss. God knows what effect it is. Whether the cumulative effect or whether the ICA effect, we don't know. That's why, see, don't worry. Don't generalize. Please trust. Be very clear. Leave it to God. That is what you can best do. Whatever is within your choice, do enjoy it very importantly. I always tell, please enjoy your preparations. You will not get this type of opportunity again in your life. Please enjoy your preparation. You should feel good. Very nice. I liked it. See, this internally makes you very strong. That's required. Okay, anyhow, we'll continue now. So now under such circumstances, the carrying amount of the player should be assessed with the best estimate of the fair value less cost to sell, and impairment shall be charged to the P&L account. Yeah. Sorry? No, going on. Now comes one more thing, property naming rights. Have you heard about property naming rights? Never? Okay. So, because next question they are going to asking about property naming rights. Have you seen this? That's called property naming rights. Property, can I go and put 36 chamber in this rickshaw there? He will slap me, no? If I go and put one, why he will allow? I should pay. Exactly. That means he has got a right to permit someone to. See, Baba, I told you everything is paid, nothing is free of cost. That they will come and paint, no, that is the cost for them, no. If simply nobody paints and simply comes and puts one board there, will you allow in your, nobody will allow that, no. Okay, now since you have understood now property naming rights, okay, now you read this question. Say Mumbai Challengers measures the stadium in accordance with the revaluation model. Yeah, it was a PP, it was already got completed also. Now an airline company approached the directors and they said, I will pay you 700 crore rupees for the property naming rights of all the stadium for next 5 years. Will you give me? You have stadium. Have you observed in stadium next to the boundary, full round advertisement is paid in crores, Geo, whoever name it is. Now, who is the owner of the property? Mumbai Challengers. Who are playing? So many set of people are playing. Now, one airline company comes and says, look, I want to put Indigo, full circle. Or you give me rights. If I want, I will use it, I will give somebody else. But next 5 years, in whatever match happens in your stadium, you should give the rights to me. and I will pay you 700 crore rupees for this. Now the problem is the 3 directors on the management of this board are both Mumbai Challengers Limited and the airline. So there are common directors among the both related party. Now additionally, the statutory legislations regulate the financing of both the cricket and hockey clubs, because money laundering can happen. So there is a very strict thing on how money comes, where it goes. These regulators prevent contributions to capital from a related party which increases equity without repayment in return. It is like something like that, no? Naming right, it seems. 700 crores they will pay, it seems. I need not return. Instead you tell, no, it's the equity contribution. And why you are paying me 700? Because there are common directors. Now failure to adhere these legislations could lead to imposition of fines without holding the prize and withholding of the prize money. Now the twist comes now like this. Mumbai challengers want to know how to take into account the naming rights in the valuation. Which standard? Of the stadium and potential implication of the financial regulations. How do you, should you consider these naming rights in the valuation of the property? No, first of all, why you need to do the valuation? Should you do the valuation? Why? Your answer is, why you need to do revaluation? Because they have opted for revaluation model. That's why you need to do revaluation. No? That's only for advertisement. I didn't sell my property to you. Now why? That's what, no? You thought, Baba, for this? There are directors, no? Who knows? What is the, that's why, should I consider that fair value, my valuation of the property, should I consider the naming rights also? Which standard? Which standard you are speaking now? Intangible asset? Chalo. Now, is that intangible assets separable from the property? Means it is part of the property only, no? You can't put, see, inside one you have got a right to put that naming rights. Can you tell them, no, next to my house there is one ground, I will give you that naming rights? No, it is a part of this. Now when you value the stadium, because why you are bothered about the intangible, are they asking about intangible right recognition there? Can you recognize it as an intangible asset? First of all, tell me. Can you recognize it as an intangible asset in your balance sheet? No, what you paid? It is a part of the stadium only, no? Okay, Baba, you can, that's correct, perfect. There is identifiability is there, you can separate it. At what value you pass the debit? Intangible asset account, debit what? That's what naming right is in bracket intangible asset. Debit what? Nothing. You cannot measure it. So standard says, yes, it is an intangible asset. But when you cannot measure it, you cannot recognize it. No, there are 3 conditions: identifiability, future economic benefits, cost. Out of these first 2 conditions are fulfilled. Where is the 3rd condition? Cost. For that naming right, how much you spent? That you cannot separate from what you spent on the stadium. So now that naming right is attached to that stadium. Now my only question is, should I consider that naming right while valuation of the stadium? Now which standard I should speak? To revenue recognition, is it my product in ordinary course of business? Okay, revenue recognition, you are talking about that giving of the property rights to someone. But are they asking how to recognize the revenue, or are they asking what is my value of the stadium? 113, few days back only we completed, no? Non-financial asset, highest and the best use. 13, fair valuation. Whatever, Baba, they are asking you valuation rights, no? Is it a entity specific or it's a asset specific? Asset specific, no. It is there with the asset. It's connected with the asset. Okay, chalo. Like this. There is one rickshaw. There is one rickshaw with the top in which anybody's name could be put. This, right, this, no, that advertisement I just showed you on rickshaw, no, this rickshaw. Okay, this, take this only. There is another open rickshaw. There is no top only. That means everything is there. It is rickshaw only. There is no cover. That cover will cost how much? That tarpaulin, no. There is a tarpaulin cover, right? Will it cost so much? No, but it is a stylish, fashionable rickshaw. Now, which rickshaw is valuable more? This rickshaw or this rickshaw? This is 1, this is 2. 1. Why? Because other than tourist revenue, it will give you extra revenue in the form of naming rights. So, when you value this rickshaw, should you value from your perspective or the market participant's perspective? Now, whether you want to give advertisement or not, that nobody is asking you. When you give to someone, what purpose they will put it for? Will they remove the tarpaulin or will they put the tarpaulin? Anybody with the common sense will put the tarpaulin. No, if extra cash is going to come, it's going to come. So, should you not include that rights also in your valuation of the stadium? That's what you need to tell. And you have to start with the 113. Now, what are the potential implications? Here you need to speak that related party thing. Okay, we'll see that. So, property naming rights are covered by, that's what students, yesterday coconut palm we have seen. Which standard? 113, where they give coconut palm valuation, 213 crores. Which standard? Which standard we are speaking? 113, where they gave in RTP, India's 41. Followed, no? So, don't go where they will give you and all. But did they ask you impairment of the PP? Did they ask you, what is it called, revaluation of the PP? No, no. They asked you valuation of the PP. Valuation is not told in India 16. It is told, they here also, it's a PP. But the valuation is told in 113. So, you say that stadium would be valued at a price which would be received in an orderly transaction between market participants. What if you would have sold this stadium to third party? Will they include the naming rights? Yes, then why you should not? So, the price which will give the highest and the best use. Now, somebody can use that stadium as a parking lot. Somebody can use one marriage hall there. Somebody can play there with the cricket with the naming rights. What somebody will use it for? Something which gives highest cash. So, these are all the important points you have to write. So, property naming rights presents complications when it comes to the property because the status, it includes suitability of inviting sponsorship. It has nothing to do with the property itself, but can be worth significant amount. Therefore, Mumbai challengers could include the property naming rights in the valuation of the stadium and write it off over 5-year period. That means they can attach it. So, since property naming rights got attached, your valuation of the stadium increased. How do you amortize it? See, the moment valuation of the stadium increases, should you not charge depreciation? How long you will charge depreciation? The stadium will run for next 20 years. But the problem is, this valuation increase happened because only for next 5 years. Do you know after 5 years, who is going to give you come with the quotation? Don't know. So, what you can do, in this property, naming right, you can treat it as a component accounting. And that naming rights, you can expense it over 5 years. Stadium will continue because, see, stadium value got increased. Will you increase the value divided by so and so, will you charge depreciation? You could have done that. But the problem is after 5 years when the naming rights are finished, then you have to impair now. Because your stadium value will fall down. After 5 years, suppose for example, this stadium is converted into one parking area. Who will come and give you 700 crores for naming rights there? No, then you have to impair suddenly. Rather than do one thing, no, you increase the value, make it as a component, depreciate that component over a 5-year period. Beautiful. Please. Yeah, you cannot, it's not an intangible. It should 113. Why? With considering highest and the best use. Not revenue recognition. It's an, when it is a PP, should you charge depreciation? Yes. When you talk about the value, stadium value plus naming right value, both the value increased, no. Stadium right is say 1000 crore, naming right is 1700 crore, life is 20 years. So what you would have done going for a depreciation divided by 20? No, standard says you include it and make the PP value 1700, take it separately, divide it only by 5 years, and this 1000 you divide by 20 years. We can treat it as an income, what we are receiving for the, because your accounting entry will be valuation, to revaluation surplus will be there. Your accounting entry will be stadium account debit to revaluation surplus. Yeah, it's an income. No? It's an income. This stadium has earned you income. It is not just your playing income, it got you naming. So your revenue will have. It's okay, why? Intellectual property rights. Intellectual property rights. Whatever. You have to apply that 115 there and check whether over a period or at a point in time. Nice. Okay, now related party. What it says in Ind-AS 24 says, related parties are generally characterized by the presence of control or influence between two parties. Now further, two parties are not related simply because there are common directors. See, related party logic goes like this. See, if I am here, this entity is here. This entity could have been connected by subsidiary. This entity could be a joint venture. This entity could be significant influence. Now, when you talk about the control, there is a control here, there is a related party relationship here, there is a related party relationship here, there is a related. See, you will never ever face the problem when you talk about related party one to one. Are you related to me? Yes, I need to check some 7 to 8 conditions. Are you my subsidiary? Are you my key MP? Are you my associate? Like this. The problem comes when there is an indirect relationship. Question is these people are related? Yes. Is these people are related? Yes. Now one more SI is there. Is these people are related? No. There is a rule. The rule says that any one leg, there should be control or joint control. When you have got one to one, there is no question. But when you have got an indirect thing, any one leg, there should be control or joint control. But if you see here, this is related to this. Everybody is related to this. But this question whether are they interrelated, that's the problem, no. Now problem is, you have got here Mumbai Challengers. You have got Airline Limited. Are you related one to one? No. Now you are related through 3 directors. Be careful when you say 3 directors. Do they have a contractual agreement within themselves? Question is silent. Now how these directors are related? It is significant influence. How you are related? Significant influence. Are you related? Answer is no. Because on both the sides, there is only significant influence. Anyhow, in Ind-AS 24, we are going to talk about this. So there is 3 directors, they are not related to each other. However, the regulator need to establish, no, you are not related as per accounting standard. But as per Companies Act, which definition is applicable? As per Competition Commission of India, which definition is applicable? There will be different definitions. So accounting standard wise, you say that not related. So in the notes to accounts, I will not give disclosure. That's maximum you will do, no. Will you say the related party definition of accounting standard and income tax definition is same? No. So that's why who has to define that? Regulator has to define. Thus, it needs to be demonstrated that airline may influence or may be influenced by the club if the deal is deemed to be a related party by transaction, not from accounting point of view, but by their whatever their transaction. Regulator will evaluate whether the sponsorship is at a fair value or not. We cannot decide. They have to decide it. Otherwise, there is a fines and penalties. Are you clear? Nice question, no? Now the most, again one more loving question for me, and the last is a landmark question called Neelanchal and Uttaranchal. Again, see, none of the question came, okay, don't worry. Read this. Neelanchal gas refinery is there. Okay, short we'll call them Neelanchal. Is a listed company. So quarterly reporting and all applicable. Involved in the production and trading of natural gas and oil. Maybe something like ONGC. Neelanchal jointly owns an underground storage facility with another entity called the Seemanchal Refinery. What is this? We'll call them Seemanchal. So Neelanchal is there, Seemanchal is there. Both are engaged in the extraction of gas, which they own and operate independently or other. Say for example, MRPL is there, ONGC is there. Both do their, let us assume that they are not subsidiaries, both are independent parties. What they have done, no? They have laid down one pipeline. Why? To get the crude oil. Now, they could have put up independently. Have you seen some house where both the house has got one compound? Who is the owner of that compound? Both. Why? Joint ownership. Why? Because why they have done? Cost effective, no, Baba. Why I should put compound for my, and after my compound, his compound has started. So both, we need a compound, no. Both will jointly put one compound for both the house. Like this, both have decided we will put one single pipeline. Why to spend money for you separately? It's the same line, no. Now, I own 60% of the underground facility, Neelanchal. Seemanchal is owning 40%. Both the companies agreed to share services and cost accordingly, 60-40 ratio. With the decision related to the storage facility, they require unanimous agreement of both. Somebody cannot come and I'll put one wall here, okay, we will change from steel into copper, we'll convert. No, both the parties should agree, then only the decision will be taken. The underground facility is pressurized so that the gas is pushed out when extracted. So there's require some pressure so that gas comes out and you can take out. When the gas pressure is reduced to certain level, the remaining gas becomes irrecoverable. At the bottom, you will always find some gas because there's no more pressure to get that, and remains underground storage facility until it is decommissioned. If you want to get it, no, then entire that tank and all you pluck it, remove. When this is going to happen? The day you close your business, then you will get this. As per the laws in force, the storage facility should be decommissioned at the end of the useful life. You cannot simply take it. For this, only at the end of the useful life only you can remove it. Now, Neelanchal has come to you and ask your advice on the treatment of agreement with the Seemanchal. This is one thing, and the accounting of the irrecoverable gas. Yes, students, what is your opinion? What is the first one? There are how many questions are there? 2 questions are there. What is the answer for the first one? What is this agreement? Joint what? No, please tell me. I am sure, or joint venture? Okay, joint arrangement. In joint arrangement, is it joint operation or joint venture? Very good. They have got, and more importantly, what is not there? What is missing? Separate entity is not there. That is what you need to start with first. If entity was there, you would have arranged, because entity not there means arrangement only, joint arrangement. How do you treat this irrecoverable gas? Some gas you cannot recover on any point of time. Yeah, tell. Abnormal loss. Okay, simple. Okay, I'll ask you one more thing. during temple renovation and all, okay, this happens. What is that? Excavation, the foundation they have to lay. In house and all we don't do, but in temple renovation, in the very center of the temple, they dig and they put some money, gold, this, that and all put, and they will start the foundation and do. Understood? If you see that, no, on the foundation day, not later, they dig and they put some gold, coin, silver, money and all they will do. House may be do, but not that much amount of gold, no. When small, as a symbolic, we may put there. You should know all these things. You should observe, more importantly. I also didn't knew. I observed it somewhere. Then I realized that, Papa, this is something Nilanchal, Uttaranchal says. They can use it only when you again decommission it. If you want, decommission it. And when you decommission it, one day you want to demolish this house and you want to construct one beautiful house. When you dig, will you get that Kopariga? At that time, you have to wait till that. Now my question is only one thing. To input that money, you have to buy the gold. Say for example, one with the good hope and faith, you have put one big amount of gold, 5 lakh rupees worth of gold. Okay. You have 2 bank account you have done. Because that guy didn't pay you, no, free of cost. You have paid to that jeweler, 2 bank account. Debit what? Donation. No, but okay, chalo, simple. Why should we go for temple? Since you told that at house I didn't observe, I observed in temple. House we will do. Let us assume that our house only we have done that. What should I debit account? Okay, chalo, on one day you decommission, no? Because you after some time, after the useful life of the building, you decommission and you start one more. Will you construct on the same foundation? No, you definitely will dig again, no, to construct one new house. At that time you get that. You will say donation received. That time you may put different amount, or that time understanding may change. Somebody may not put that money only. Next generation say, what is this practice? Now my question is, on day 1 if you treat it as a donation, on day 10, on year 10, will you take donation received? No. What it is then? It is? Then where is cost debited? Debited to the PP. That's what I'm telling Baba. Why we have to go there? Why we have to audit this Nilanchal, Uttaranchal? If we understand the principles in our day-to-day life, what just observe. Same principles in applicable for this complex accounting. That's why accounting is very simple if you have understood it. It's the part of that asset. Okay. So now here that irrecoverable loss is like an investment in the PP, which you can recover only later. If you want, you can charge depreciation, and at the time you say scrap value received. Obviously, you have to charge depreciation. It should be part. Okay. So this is the thing. Okay. There is a decommissioning cost also. You have to make an arrangement. Contingent liability is there. Now, where is the contingent liability here? Decommissioning is a decommissioning cost. No. See, when you have put up this, okay, you read here, they have got an obligation where they somewhere they said no. Somewhere they said, as per the law, storage facility should be decommissioned. That means you have got an obligation on your head. Decommission. Where is contingent liability here? Where is that? Tell me. Where is decommissioning liability? What is the contingent liability is where for Nilanchal? Just tell me where is contingent liability for Nilanchal? That is a contingent liability. That your decommissioning cost, no? That is the decommissioning cost. Now, legal what you are talking is a decommissioning cost, right? Where is contingent liability? Simple. I will tell you. You and your friend, okay, go to one person, your known person, and borrow something, okay, who has to return, and you have got one internal arrangement, 60 for me, 40 for you. Followed, no? Now the day comes when that whatever you have borrowed, you have to recover, you have to repay. Friend has absconded. Will you go and tell, sir, I have got only 40 from him, 60 from him, take my portion of 60? What that person will say? He says, Baba, whatever internal arrangement, no, I am not interested. What you have given, come and give me. So now when you have set up in a joint arrangement with the 60-40, when you in front of the eyes, you have got together 100%. No, 60% of the decommissioning cost you will recognize in your books. But what about the 40% of the other portion? It's a contingent liability on your head. No. What if CAFinalFR is closed after 5 years? Who is going to remove this? Neelanchal. Huh? It doesn't matter. 50, and you know one fun nice thing? CAFinalFR has to recognize 60% contingent liability there. For them also Ind AS is applicable, no? See, now when you see this all information in the financial statement, then it exactly gives what is your position there. Then should I invest or not? First only I will know. Otherwise I will invest and Neelanchal will run away. CAFinalFR will pay their money to the bank with this government, and next day morning they will put one, they will turn the board like this, closed. And what I should do? Then first immediately I'll ask, when there was one contingent liability, why our auditor didn't tell that? Auditor will say, I didn't understood the business, meaningless, hire. Then they say, submit your license. As an auditor, you are supposed to understand the business. No, business risk is the starting point for you. And understand the business practice and see what accounting they are doing. Okay? So how to answer this case A? So you are going to say, the joint arrangement, 111 you are going to speak. Is it a joint control? Yes. Why? Because there is a unanimous consent. Now a joint arrangement could be two things. What it is? It can be a joint operation or a venture. See, this is analysis. Is this a joint arrangement? Yes. Why? Because of unanimous consent. Now how do you classify? First thing, I will look for the structure. If it is not structured, it is a joint operation for me. Yes, in the given case, then I will look for the contractual arrangement also. The joint, since it is a joint operation, joint operators will account for their portion of the assets and liabilities as per their respective index. So that how much PP, I will take 60% of it. I will take 60% of the decommissioning liability. I will take 60% of that irrecoverable loss. Are you clear? Followed, no? See, one thing is you are conceptually clear. Second thing is you have to learn the skill of writing it as it is. Now, in the given case, yes, it is a joint operation because decisions are unanimous. There is no separate vehicle is there. That is why contractually agreed to share their services. So, Neelanchal should recognize its share of PP. So, very clearly you told Neelanchal Baba, this is a joint arrangement for you. Don't consider it as a joint venture and all. Ind AS 28 and all don't apply here. You have to do it like this. Then suddenly one more question came, sir, what about that irrecoverable gas? Now you call Ind AS 16. Look, you say that dismantling or restoring cost is available. And Ind AS 37 says that where the effect of time value of money is very material, you have to create a provision by discounting it. So 10 years down the line, what cost you are going to incur? This is the same problem we have done in 113, fair value of a decommissioning liability. By discounting the future cash flows, you find out the, make a provision. Further, it says that when you are jointly and severally liable for any obligation, yes, for the other party's responsibility, if there is one contingent liability show in the off balance sheet. That's what I was telling now. From bank, if you have taken joint loan, who has to repay the loan? Logic means if the bank is not going tomorrow, the other party is absconding. Law will ask you to do it. But when you have to do, how much liability you will incur? 100%. How much provision you have made? 60%. So when suddenly one big expense, 40% expense is going to come. No. People will ask from where it came. In partnership and joint and several liability. Be careful, entering into partnership. What is that? That is internal, no, Baba. Outside people, when you take the loan, have you told this bank? Have you told bank it's a LLP? Bank will say, then you go. I am not going to give. All are smart outside. Followed, no? We are all, see, I am telling you, we have all theoretically seen. Sometimes I wonder why I worked 10 years in a company. But at least it gave me an opportunity to know the outside world. So I always suggest, please don't get into anything, first work outside. Go 2 to 3 years work outside. You learn some, like how the world works. Followed, no? This is the way the contracts will be framed. So this is the very important point. You have to write Index 7, Index 37. Now application, yes, decommissioning cost has to be recognized. PP to decommissioning provision for your 60%, and Neelanchal will recognize 60% of the decommissioning cost. Clear? Yes. Next, further, they also should disclose 40% as a contingent liability for the others portion as per Index 37. Now, how to account irrecoverable gas? It is necessary for the storage function, because without this, without incurring that, the pressure will never build. So, my asset will never be ready for use unless I fill with that minimum irrecoverable gas. So, should I not capitalize that? So, I should capitalize how much? Only my account of 60% only, and I can depreciate it over the residual over the life of the storage facility, because it will remain in the storage facility till its useful life. However, if any gas is recoverable upon decommissioning liability, since already you have written it off over the useful life, it will be gain for you. Okay, it is the disposal from the sale of scrap. You will recognize in the income at the last. How much? Your portion. Clear? Okay. The natural gas in excess of the irrecoverable gas should be treated as an inventory. Whatever that more than that base, no, that should be your inventory portion. Okay. Not simple. Okay. And the last part of this question, only 2B, 4B. Neelanchal has entered into a 10-year contract with Uttaranchal. Very fantastic question among all the questions. After this, we are done. Okay, we will go into other type of question. Okay, and we will finish today with this. Neelanchal entered into 10-year contract with Uttaranchal Refineries Private Limited. We will call them Uttaranchal for purchase of natural gas. Now, Neelanchal has paid advance to Uttaranchal equivalent to the total quantity of gas contracted for next 10 years based on the forecast of the gas price. Possible, no? Enron and all did the same thing. Like what I do, simple. Like, see, like more, super bazaar. You need every year 1 kg sugar. More comes with the offer. Pay me 12 months sugar, every month one you want, no? 12 kg sugar you pay me right now, I will give you this much discount. What you will do? Newspaper, I don't know. Newspaper will buy, no, subscribe. No, my question is, every month you need 1 kg sugar. Now more comes with an option, more or super bazaar comes with an option. See, you buy 12 kg of sugar right now. Delivery you take every month. See, prices are varying. Today this, tomorrow that. Now, next 12 months, at least you forget about sugar. I am going to give you sugar. And at what price? Discounted price I will give you. Will you not enter? Like this, Neelanchal, Uttaranchal came and gave one big concept there, and Neelanchal purchased it. Now, this advanced amount carries an interest at the rate of 12.5% per annum, which is settled Uttaranchal by a supply of extra gas. He said, look, Baba, why should I pay in advance? Now, see, if I pay in advance right now, see, 1 kg sugar is 30 rupees. Okay, 12 kg sugar is 360. You are asking me at the rate of 30 rupees, you pay me 360 rupees right now, correct? Now, if I pay you 360, Option 1 is I will pay you present value of 360 right now. Or if you want me to pay 360 to you, I will pay it. But on 360 you should give me interest, no? But don't pay me interest. You give me, if I want that extra sugar, no? You give me half kg sugar equivalent to this interest on this portion. Clear how this works? Okay. Now the contract, now comes the fun. The contract requires fixed quantity of gas to be supplied every month, like 1 kg sugar. Additionally, there is one price adjustment mechanism also in the contract, whereby the difference between the forecasted price, that 30 rupees what you agreed to pay for that sugar, that's the forecasted price, no? And the price of market may be 35 rupees, market may be 20 rupees. There's a plus or minus for both the people, no? That's why that Moore or Super Bazaar told you, look Papa, you are also in danger, I am also in danger. So we'll do one thing. You pay me with one forecasted price, but we will adjust with the market. One thing is for sure, before I give to any customer, I will give it to you. That means in your city, nobody is having sugar because there is a short supply of sugar. But your house will have sugar. Why? Because you entered into long-term contract with me. Whatever market prices I may supply you, but tomorrow you may be willing to pay more price, but nobody is offering you sugar, no. So we'll have this price adjustment, and difference will be settled in cash on a quarterly basis. And one more thing, one more clause. If the Uttaranchal is not going to deliver the gas as agreed, like that day Morris or Super Bazaar is not having the sugar, Neelanchal has got a right to claim the compensation based on the current market price of the gas. That means I can go to another local store. I need sugar no, every month. I will go to the local store. I will buy the sugar from them. Now I might have paid 45 rupees. As per our contract, I should have got at 30 rupees. 15 rupees you have to reimburse. Now again Neelanchal came to you and they are asking how to account the contract with Uttaranchal in accordance with 109 financial instrument, and seeks your inputs in this regard. Is a financial instrument? Financial liability? No, who is having financial liability? Who came to you? Neelanchal, what it is? Financial asset? Then what it is? Is it an advance to the supplier? Derivative, somewhere I heard one beautiful word. What is that? What is that? Where it comes? Derivative. Is that derivative contract now? You have already placed one purchase order. Is that a derivative contract? Should I do MTM of this contract? Or MTM, mark to market? Because if it is a derivative, then every quarter or every whatever period, it's like a forward contract, no? Then every month or every quarter, whatever, I am a listed entity. Do you expect me to do MTM of this contract? Or can I consider it as a own use exemption? There is one own use exemption, no? We discussed at that one, that table chart and all we discussed at the end. What does that own use exemption says? It says that, look, if you are entering into any forward contracts for your own consumption, you need not treat as a derivative instrument and don't account it. Like you account it normal executory contract. And whenever you purchase, you account it. No, it's not a, where is the financial assets? No, for them you see that the advance portion what you have paid, okay, that can be a premium type of thing, no? You are paid some amount, okay, like an advance money, like an advance, and they said that, see here students, what did they say? The total quantity of gas contracted, this advanced amount, Uttaranchal Neelanchal has paid an advance to Uttaranchal equivalent to the total quantity of the gas contracted for 10 years based on the forecasted gas price. Some amount they must have paid, no? But you don't know, not 115. That is for them, who is sellers. We are not talking from the seller perspective. You have paid one amount. Now, that amount payment, can I say it's like a margin? Because see, today you have forecasted petrol price is 100 rupees. When 2035, do you say? It can be 1000 rupees, no, in 2035. But you have calculated my 10 liter I require into 100 rupees, and you have paid 1000 rupees. The clause says that every quarter, the difference between the forecasted price and the prevailing market price has to be adjusted net in cash. That means what you paid is a one chiller, some God knows now what type of calculation you have done. You might have paid one marginal money there. And maybe you are dealing with one derivative contract only because you have given one right to not to supply, no? Return put option is there, no? See, suppose if you enter into one sugar sale contract with the Super Bazaar, will you tell the sugar, that Super Bazaar, if you don't want, don't supply me? Then how can you say it's the own use exemption? If you really wanted it, you insisted, no, irrespective of how to supply me. That means if you have given here one right to them, if you don't deliver, that I will buy from third party, you pay me the net settlement. Followed? Yes. So now we have to evaluate it from the point of derivative contract. How? Ind AS 109 is not applicable to own use contract to buy or sell a non-financial. Is it a non-financial asset? Which one? Gas or petrol, as per expected purchase requirement. In such case, you may treat it as a normal purchase or sale and don't apply derivative accounting. This is what your Ind AS 109 says. Now, below are the exceptions for the own use. That means everything then I'll say own use only. Even derivative contract also I'll say it's own use. Then they say no, wait. Let us go through the contract and read it, and we'll see. First of all, can you settle net in cash? Now the question comes, what is net in cash? A contract may be, okay, this is one, we'll see what is net in cash. Second, a contract to buy or sell a non-financial item that is irrecoverably designated as a measurement at FVTPL. Have you designated that contract in FVTPL? No. So this is not applicable. Any one condition fulfills, then there is a problem. Okay, entity enters into future sell contract after placing the order and want to do hedge accounting. Such type of things they are not told here, that you entered into futures market, did the hedge accounting and all. Or a written put option has been granted by the entity to someone. That means you are a writer. You are given a put option to sell or not to sell this financial asset. Because who owns own use consumption, who will never ever give this type of option to the seller. If you don't want, you don't sell. I would have already told you have to give me. That's why these are all the exceptions. If you find any one of these, no, yes, then you have to treat it like a derivative. Because generally people who want to use own exemption, no, like suppose I told you example of this birthday party food. When you place an order with a caterer, you don't include one clause, no. If I don't want, I will cancel it. You pay me the net settlement. You will always say, please deliver it to me. You don't want to do you get into a hedge accounting there? After you place order, you go to the market and do betting? No. Will you give written option to them if you don't want on that day, on my birthday day, don't supply? Nice, no? To tell friends you didn't supply only. No, that you don't do. That means when you have placed an order with the caterer, it was a forward contract, but it was for own use exemption. So 109 is not applicable. Clear? Now one more question comes, sir, what is net in cash? Net in cash, that terms itself specify, which is there in this question. Sometimes I don't specify, but I have got a practice outside the thing. I'll not mention, but I will do it. Or entity takes delivery and sell immediately. Or contract is for items which is readily convertible into cash. This gas may be readily convertible, gold. So they will not permit me. After you write all this theory, which you have to write depending upon how many marks they will ask you. Otherwise, Don't go behind all this theory, come to the application. In the given case, now the contract with the Uttaranchal will result in physical delivery of the extra gas. Accordingly, it appears to be a own use contract because you are not settling net in cash. What did you say? You say, give me extra 1 kg sugar. If your objective was to adjust it, you would have adjusted in cash. So this gives me indication that it must be for own use consumption. However, there is an argument. The contract is net settled due to penalty mechanism. So they have to compensate you. Further, if natural gas is readily convertible into cash, then definitely I will attract that condition there. Like sugar, you buy and you can sell it to someone. So whether you ask the supermarket, pay me in cash or pay me in sugar, it's one and the same, no. Additionally, if there is a volume flexibility, the contract would be regarded as a return put option. Because you are told, no, that Uttaranchal, if you don't want use, you don't supply. It's called a volume flexibility. That means when your production is low, supplier has got like his low, what is it called, so low supply, don't supply me. Now final judgment, however, the contract will probably continue to be own use exemption because by looking at all this condition, it looks like this. Additionally, entity has not irrevocably designated the contract at FETPL. Thus, it all indicates, shows that it is own use exemption, but be careful with this particular entity and this contract if you are an auditor. Are you clear? No, see, how to write, that is the different story. Again, never came. But do you appreciate the question here? Do you see the way they ask you this question? Very nice way. It gives you better understanding about the applications. Yes, question number